Welcome back to the Pro Ticker Podcast. It's your Friday morning edition, covering major financial magazine headlines, everyone. And if you're looking for, well, a shortcut to really get what's driving the financial world this week, you're definitely in the right place. Our mission today is a real deep dive into the source material. We're talking CNBC, Reuters, Bloomberg, Yahoo Finance. We want to synthesize the three huge forces that really shaped this Friday, September 19th, 2025. We're looking at central bank strategy, these massive corporate power plays, and the rising tide of geopolitical risk.
It really is an incredible mix, isn't it? Almost contradictory signals out there. You've got the Fed easing rates, which you'd think means, okay, risk off is maybe ending. But then you see companies like Nvidia spending, well, trillions almost, to reshape global supply chains. That suggests they see huge competition ahead. We're going to help you figure out which pressures, matter most right now.
Yeah, absolutely. So today we are unpacking the Bank of Japan's balancing act, which seems increasingly strange. But we're going to look at Nvidia. I mean, $4.28 trillion market cap.
Yeah.
How are they using that massive cash pile? It's not just innovation. It looks like a strategic tool in the U.S.-China chip wars.
Exactly. And finally, we'll connect the dots. We'll link the Fed's easing this Hedge America trade, which sounds fascinating. We'll get into that. And the very real quantifiable impact that trade tension and, frankly, political risk is having on earnings. We'll use FedEx as a case study there.
Okay, sounds like a plan. Let's not wait. Where should we start? Tokyo.
Let's do it. Let's start this deep dive right in Tokyo. Okay, so the big story out of Asia this morning, and this is coming from both CNBC and Reuters reports, it's all about the Bank of Japan, the BOJ. They announced their latest decision, and they're keeping the policy rate steady, right at 0.5%. Now, this was actually expected. A Reuters poll had forecast this, so the headline number itself didn't cause a huge immediate stir.
Right, but the context around why they held steady, that's where it gets tricky. And frankly, a bit confusing. The BOJ is trying to, normalize policy after decades of really extreme easing. But the domestic data, it's actually slowing down, which you'd think argues for holding steady, maybe even easing back a bit if they feared recession.
That's the puzzle.
Yeah, Japan's core inflation. And remember, that strips out fresh food prices, which bounce around. It fell to 2.7% in August. That's the lowest since way back in November 2024. It's the third month in a row it's declined. And headline inflation is also just 2.7%.
And that's the paradox, exactly. Inflation is slowing, yet they seem reluctant to completely stop this normalization path they're on. Hiroaki Amemiya from Capital Group, CNBC quoted him, suggesting this hold, and I'm quoting here, underscores its cautious stance amid slowing inflation and global uncertainty, prioritizing stability over premature tightening.
Okay, stability over premature tightening.
It sounds like they're deliberately trying to give this early-stage reflationary cycle more room to breathe. They're maybe worried about pulling back too soon, like they've done historically, right?
Okay, that makes sense, prioritizing stability. But if that's the goal, why does the market reaction seem so nervous? The Nikkei 225, it hit record highs earlier this week, but then it pared those gains back, fell about 0.57%, and the yen actually ticked up a bit, 0.14% against the dollar. But the real instability signal, that seems to be coming from the bond market, isn't it?
Absolutely. Yeah, you hit the nail on the head. When you look at bond yields, you see investors are actively pricing in tighter policy pretty much regardless of what the BOJ is saying right now. LSEG data, which was cited in the reports, showed yields on Japan's short-term two-year government bonds rose to 0.885%.
0.885%.
Yeah. That's the highest level since, get this, June 2008.
Wow. Okay, let's just pause on that. If the central bank says, hey, we're holding rates at 0.5%, half, but the market demands almost 0.9% to hold their two-year debt. That means bond traders are basically calling the BOJ's bluff.
That's it.
They're saying, nope, a rate hike is coming, and soon, even though inflation is slowing down.
That's precisely right. And their belief, it's strengthened by what's happening inside the BOJ. Bloomberg reported the rate decision wasn't unanimous. Not at all. It was a 7-2 vote, and those two dissenters, they actually counter-proposed hiking immediately to 0.75%.
Whoa, wait. Hike immediately to 0.75%. But if inflation is already slowing, wouldn't that risk choking off the very recovery the BOJ says it wants to nurture? Why the push?
Well, the thinking from the dissenters is likely about credibility. and
Yeah.
maybe preventing future speculative pressure. If the Fed is easing and global pressures maybe stabilize the yen for a bit, the BOJ dissenters might worry that if they wait too long, they'll be forced into an even bigger hike later on. You can see this in the markets. Overnight index swaps now show traders are pricing in about a 54% chance of an October hike.
Just based on those two dissenting votes.
Largely driven by that, yeah. It signals a really significant shift in the bank's internal thinking, a crack in the consensus.
Okay, so internal pressure for a hike. And just to make things even more complicated, there was that separate announcement, also reported by Bloomberg. The BOJ said it's going to start selling 620 billions worth of ETFs every year. Why did that specifically spook the market and hit tech stocks?
Yeah, that's a really crucial piece. It ties back to their history. See, the BOJ bought up a huge amount of exchange-traded funds, ETFs, over the last decade. It was part of their massive stimulus. And those funds, they're heavily weighted towards the big companies on the Nikkei index.
Okay.
So Rizona Holdings noted that this announcement basically signals the beginning of the end of that direct support. By becoming a seller, and a systematic one at $620 billion a year, they're putting specific downward pressure on the biggest stocks, many of which are tech names. So that worsens sentiment way beyond just the rate decision itself. It's a very, very complex picture coming out of Tokyo this week. Holding rates, selling assets, internal fights. Busy times.
Definitely complex. Okay, let's shift gears. Moving from that sort of cautious, maybe even confused policy in Tokyo, let's look at a source of absolute power and confidence. Nvidia. They are wielding a market cap that's just staggering, $4.28 trillion. That's strategic firepower, unlike almost anything else. The question CNBC was asking is, what do you even do with that kind of cash pile when you already dominate the AI hardware market?
Yeah, you're not just going to roll around in it, right? And this is where it gets really, really interesting. This was detailed by both CNBC and Yahoo Finance. Nvidia took a massive strategic $5 billion stake in its old rival, Intel.
Wow, Intel.
Yep, amounts to about 4% ownership.
That's collaboration on a scale I didn't see coming. So what's the deal?
The core idea is they're going to jointly develop AI systems. Think data centers, PCs, combining Intel CPUs with NVIDIA's GPUs and their networking tech.
Okay, leveraging strengths.
Yeah.
And the market reaction.
Visceral is a good word for it. Intel shares popped an incredible 22.8% on the news.
22.8%.
Yeah. Their best single day since, wait for it, October 1987. That's a massive vote of confidence from the market.
Unbelievable. But why Intel specifically? Why now?
Well, if we connect this to the bigger geopolitical picture, this investment is about way more than just tech collaboration. It's really about strategic national interest. See, Intel Foundry Services, that's their contract chip manufacturing arm, it's been struggling, lost something like $13 billion last fiscal year.
Right, I remember reading about that.
But the U.S. government sees Intel as critical because they're really the only large-scale U.S. company making leading-edge chips. So this $5 billion stake from Nvidia, it effectively throws a lifeline. It adds credibility, adds capital to Intel's efforts to really revive domestic advanced chip manufacturing.
Okay. So Nvidia isn't just buying tech access. They're strategically helping to stabilize and expand the U.S. supply chain for their own future products. It's a direct response to global competition, especially China's push for chip self-sufficiency.
Exactly. That 4% ownership makes Nvidia a key player in maintaining U.S. chip leadership. But the ripple effects are huge, especially for the big Asian chip makers like TSMC and Samsung. Reuters had analysts describing this Nvidia-Intel deal as a, quote, double-edged sword for them.
A double-edged sword. Tell us why. How can Intel getting stronger be both good and bad for TSMC?
Okay, so analyst Luke Lin suggested an Intel revival is actually good for TSMC in one way. It eases U.S. pressure on TSMC to build really expensive new factories in the U.S. If Intel succeeds domestically, it takes some of that political heat off TSMC.
I see. Less pressure to onshore production.
Right. But the downside, long-term competition, obviously, and immediate client risk. The big worry right now is for AMD. They're one of Intel's main rivals, right?
Yeah.
But NVIDIA and AMD are direct competitors in GPUs. So NVIDIA teaming up with Intel, that could lead TSMC to lose valuable server chip orders from AMD down the road. It's like a fundamental shakeup of the whole supply chain power dynamic, favoring this new NVIDIA-Intel partnership.
It really shows. NVIDIA sees its cash not just as profit, but as strategic armor. And we saw other big cash moves from them this week too, right? CNBC and Reuters reported on those.
We did. They spent over $900 million just to acquire the CEO of an AI startup called Infabrica and license its technology.
$900 million for a CEO and tech license.
Hmm.
What does Infabrica do?
It's crucial tech. It's specifically designed to scale up and efficiently connect, like, over 100,000 GPUs together. So they're buying the talent and the plumbing needed to make sure their massive chip deployments actually work seamlessly at scale.
Investing in the ecosystem around their chips.
Precisely. And they're pouring money into global infrastructure, too. They unveiled $11 billion, that's about $15 billion US and UK investments. That includes deploying 120,000 of their new Blackwell chips there. And they're exploring a potential $500 million investment in a self-driving startup called Wave.
Okay, so they are absolutely cemented their position. They want to be the indispensable hardware layer for the entire global AI build-out everywhere.
That looks like the plan.
Yeah?
Total hardware dominance.
Okay, let's broaden out now. Let's connect these huge corporate moves like Nvidia's to the wider global picture. We're talking monetary policy and these intensifying political risks.
So the big news on the monetary front this week was the U.S. Fed. They cut rates by 25 basis points. That moves the benchmark rate down to the 4.00% to 4.25% range. And they signaled 2 more cuts likely coming this year.
Yeah, the Fed's move, CNBC called it a risk management cut. It has really profound global ripple effects. It basically opens the door wide for other central banks, particularly in Asia, like South Korea, Australia, India, to continue their own easing cycles. They can cut rates without worrying quite so much about massive capital flight towards the higher-yielding U.S. dollar.
So the Fed easing gives others cover to ease, too.
Exactly, which makes China and Japan stand out even more as the only major economies still kind of defying this global easing trend, for now at least. And this global rate dynamic, this seems to be the key driver behind that fascinating shift. Bloomberg highlighted the Hedge America trade. It sounds counterintuitive. Buying America but betting against the dollar. What exactly is this strategy?
It's pretty sophisticated, and it's really fueled by uncertainty. Global investors are basically doing 2 things at once. They're buying attractive U.S. assets, could be stocks, tech companies, corporate bonds, you name it. But at the same time, they're buying insurance, essentially hedges, against the U.S. dollar falling in value.
So they like the returns in the U.S. market, but they fear the currency itself weakening.
Precisely. They love the assets, fear the dollar.
Okay, but why the sudden fear of the dollar? The U.S. economy is still relatively strong, isn't it?
It is. But 2 big factors are driving this dollar caution. First, lower U.S. interest rates simply narrow the dollar's yield advantage compared to other currencies. Less incentive to hold dollars just for the interest. And second, and this is crucial, mounting trade and political uncertainty. Investors are nervous about policy stability. Bloomberg suggests this hedging trend is massive, could be reaching $1 trillion.
$1 trillion in hedges.
Yeah, and that's a major reason why the USD has already slid about 9% so far in 2025. Investors are literally factoring political instability risk directly into their currency bets.
And we can see the concrete impact of these trade policies showing up in corporate earnings, right?
Yeah.
FedEx is a good example you mentioned. Their shares rallied 5% on an unexpected profit beat, according to Reuters and Yahoo Finance. Wall Street liked the sound of that.
They did, but how FedEx got that beat is key. It came from really aggressive internal cost cutting, a $1 billion plan, parking planes, closing facilities, painful stuff.
So they're basically trading some future growth potential for better profits right now.
That's a good way to put it. But even with those deep cuts, they confirmed the direct, measurable hit from trade policy changes, specifically the end of what's called the de minimis exemption. That used to let low-value shipments skip customs duties. That's gone now, mostly.
Right, a change that impacts a lot of e-commerce.
Exactly. And FedEx said losing that exemption cut their first quarter revenue by $150 million. Their chief customer officer, Brie Carrier, noted that combined with other pressures, these trade policy shifts represent a huge $1 billion headwind for their fiscal year 2026.
$1 billion headwind. That's massive for a company like FedEx. That cost has to go somewhere, doesn't it?
It does. It either gets passed on to you, the consumer, as higher prices for shipped goods, or it forces FedEx to slash investment even further in future capacity and efficiency.
So it's a real quantifiable drag on economic efficiency caused directly by trade policy.
Precisely. It shows these trade wars aren't just abstract political talk. They have real, measurable costs that directly shape corporate strategy and long-term investment plans. And meanwhile, China's pushing back. Reuters detailed how the China Association of Automobile Manufacturers, CM, launched an anti-discrimination probe. They're looking into the impact of U.S. trade policy, specifically regarding chips used in cars.
An official probe from China.
Yeah, and this comes right before a new round of U.S.-China trade talks are supposed to happen, focusing on tariffs and, yes, TikTok again. It feels like an escalating tit-for-tat on the regulatory front.
Okay, and we can't ignore how pure political risk, not just trade policy, feeds directly into that hedge America currency strategy we talked about. CNBC and Bloomberg flagged two pretty significant political headlines this week that speak to, well, institutional stability concerns. First, the Trump administration asked the Supreme Court to allow the firing of a sitting Federal Reserve Governor, Lisa Cook.
Right, and this is critical because it's seen as a direct attack on the independence of the Federal Reserve. For global investors, the stability and perceived independence of institutions like the Fed are paramount. If that's called into question, it just ramps up institutional risk. And that fuels the uncertainty driving investors to hedge the U.S. dollar, even if the economy looks okay on the surface.
Makes sense. And the second one. The president suggested potentially revoking broadcast licenses for networks like ABC Disney if they're critical of him. This followed the suspension of Jimmy Kimmel's show.
Yeah.
That feels like more than just media drama. It sounds like regulatory uncertainty for major corporations.
Oh, it's a profound demonstration of regulatory risk. When a government even threatens to revoke the fundamental operating licenses of major companies based on political criticism, it forces all companies, media, tech, manufacturing, everyone, to factor in really extreme political variables into their basic strategic planning. This whole climate of instability, it just validates why global investors might think, yeah, betting against the dollar, doing the hedge America thing, that seems pretty prudent right now, regardless of underlying U.S. economic strength.
It paints a picture of deep underlying nervousness, even with positive headlines like the Fed cut or Nvidia's moves.
Yeah.
Hashtag tag conclusion and outro. Okay, so that was a lot to unpack. What does this all mean for you, our listener? Let's try to quickly synthesize the three main takeaways from this incredibly complex week we've seen in the financial news.
Okay, first takeaway, Japan's BOJ. They're trying to play it cool, holding policy steady even as inflation drops. But the internal dissent, those two votes for a hike, plus the new pressure from selling ETFs, it signals major volatility ahead. An October hike looks increasingly likely, which would really make Japan stand out against the global easing trend.
Right. Second big point, Nvidia. That's staggering capital, that $4.28 trillion. They're using it for two big things. One, securing their global market dominance in AI hardware. Two, strategically propping up U.S. chip manufacturing through that big $5 billion stake in Intel. It's business, but it's deeply geopolitical too.
Absolutely. And third, those global trade wars and, frankly, political actions that attack institutional independence, like questioning the Fed. They aren't just noise. They are persistent, measurable cost factors. We saw that quantified in FedEx's $1 billion headwind number. And this instability, it's the primary fuel driving that hedge America trade, where investors buy U.S. assets but simultaneously bet against the U.S. dollar itself.
Okay, so that brings us to our final thought for you to reflect on this weekend. How long can China and Japan realistically keep swimming against the tide of global rate cuts being led by the Fed? And maybe more profoundly, what happens to the U.S. dollar if this hedge America trade, where fear of institutional risk and political uncertainty starts to outweigh fundamental economic strength, becomes the new permanent normal for global investors?
That's a really fascinating prospect to chew on as we head into the weekend. For now, though, that's our deep dive for this Friday. We'll see you all Monday morning with new headlines from major financial magazines.